Hello all. Today we are going to discuss an interesting topic which is always a debatable topic, but I am putting my perspective of that to you. So, is it advisable to take a debt or take a loan to invest in stock market? So, theoretically speaking, you should not take a loan to invest in stock market, because if you generally browse through YouTube or through Google it out, or if you hear great investors like Warren Buffett who always tells that you should only invest the money you afford to lose.
But there'll be a year when you write two big checks for super cat claims when the market is throwing away things at really silly prices. Could you share your thinking about how much debt you would consider taking on to buy great businesses as cheap in that kind of a situation?
Well, if we had both a big hurricane in the Northeast or in Florida, and we had a big quake in California in the same year, and we had a financial market, the financial markets tanked, perhaps because of those events, but perhaps for other reasons, we would be thinking about ways. It might not be borrowing money directly, but we would be thinking about ways to buy securities if they got cheap enough. I mean, anytime securities get cheap, Charlie, you're thumping again here. Anytime securities get cheap, we don't like to go to the office and not write a ticket. I mean, we certainly would have the ability to borrow some money. We would never borrow a ton of money relative to capital. We're just not set out that way. We don't want to disappoint anybody in this world. We don't even want to worry about disappointing anybody in this world. So,
forget about affording to lose. You are taking a loan and you are investing in the market, and buying a stock means it is much of a risk compared to all the sayings in the stock market or the veterans who talk about not taking a loan for investing in stocks. But unfortunately, I tend to deviate from all this. I have a different perspective on this. First of all, what is risk? Let us dissect it. Risk is something which we don't know about, or risk is something about which we don't know the actual outcome. We have an uncertainty about its outcome. But if you know the end-to-end situation, and if you know the actual way by which it works, and you actually is able to anticipate the outcome of the investment in a precise way, then it is no more a risk. Risk is, as I told, something about which you don't know or you partially know about. But if you learn it in full, you know the complete thing in and out, then it is no more a risk but a anticipated investment. If you have a proper investment strategy added by a long-term view of investing, then the risk is completely mitigated. In the sense, if you analyze the stock which you are going to buy properly, whether it is undervalued, how the business is run, what is the business model, how is the management, how is the cash flow generation, how is the past performance, how is the future projection, what is it going to do in the future, what is the capex plan, how is the management working, are they ethical, do they have a proper compliance, how they have done the things which they have promised in a earlier time, and have they met that commitments. So all these things, if you really analyze, you know about the stock or the company which you are going to own, and the short-term volatilities you are killing because of, say, events like COVID, the pandemic, or say Ukraine event, Russia-Ukraine war, and all this Hindenburg reports about Adani, etc. So all these things you can just take it as a short-term volatility or short-term noise in the market, and if you give a long-term view or long-term investment period for the stock which you are investing in, then the risk is completely mitigated. Now, talking about investing using a loan, so if your cost of capital, which is the interest you pay, say you took a loan at 9% interest rate, say 10 lakh is taken at 9% interest rate, you are paying an EMI monthly, and if you are generating profit out of the stock market, like you are putting the money in a stock, and that stock may not perform for a 6 months or a year, or maybe slightly more than that, but still your cost of capital in that period may be more than your return on investment. Return on investment is the stock appreciation and the dividends which the particular stock is giving. So a stock may not give a dividend, I'm just generally speaking. So if the stock is not giving the dividend, then that dividend money is equivalent is also invested back into the business, so the stock price will go up. So either of the case, the cash flow which is getting out of the business will make the stock price go high and leads to our capital appreciation. So in the first year, say the stock is flat or say went down 10%, again you put some money into that and average the stocks, provided the stock you have identified is a quality stock. And then going forward, your cost of capital will be lesser than your return on investment, because the stock starts to fly in the second year or in the third year. So your annual return, say, for that stock is 15%. Say first year minus 10, second year 30%, then the third year say 20%. So average, or if you take it as roughly 15%. So your cost of capital is 9%, your return on investment is 15%. So it is almost double of the cost of capital, that is a return on investment. So if your return on investment is much more than your cost of capital, then I'm very happy, because using others money, because the loan which you have taken out is others money, it is not your money, because you have taken it from a bank or an institution or a financial institution, or maybe from your company who is giving it at an interest rate. So using others money, you are generating a cash flow or a stock appreciation in this case, and you are creating money by using money which is not yours, which is the beautiful way of generating an asset or a cash flow. So as per me, if you mitigate risk by knowing the business you are investing in, and if you give a long term perspective to this, then you are mitigating the complete risk of negative returns, and you are getting a return on investment much more than your cost of capital. So this is like you are making money work for you. Again, talking about the cash flow quadrant, you are becoming an investor on the right hand side quadrant. So this is how you create cash flow, by borrowing money and investing in stocks. So do let me know about your viewpoint on this topic in the comment section. If you like the video, do hit a like button. If you are not subscribed to our channel, do subscribe, so that this idea or whatever I am putting in efforts, these things are flowing into the people who are really needy of such ideas, and make them enlightened. See you till next video. Happy investing.